From the morning reading, Spider new high close, small caps and healthcare lead. Spider resistance day 4. Sellers control open, buyers control close again. 7 of 9 sectors moved higher on Thursday. XLV, XLY, and XLB were the strongest sectors, while XLE was the weakest sector. Oil futures rose 15 cents to close at 49.06. The S&P sold off at the open to its 0.51% intraday low 20 minutes into the session, while market mavens pondered this morning's ADP employment report and the weekly jobless claims. The index then reversed the trend and rallied steadily throughout the day to its close at its intraday high with a modest 0.28% gain. That puts the index above the 2100 level for the first time in 30 sessions and at a high for 2016. The 500 is now only 1.2% below its record close set over a year ago on May 21st, 2015. Professional investors are much more optimistic than amateurs. 2 established surveys focused on finance pros are showing an extreme amount of bullishness, while 2 surveys focused on lay investors are coming off extreme pessimism. Based on other times there was such a wide spread between the 2 groups, the pros cannot be considered smart money. Margin debt has declined 10% over the past year. The latest figures from the New York Stock Exchange show a drop from peak debt levels in April 2015. Declining debt has been a negative factor for stocks, and even when the decline reaches 10%, it has not been consistent enough to suggest that the decline is enough to show capitulation. The S&P closed at a 6-month high. When it has managed to do that before the non-farm payroll report, it rose the day of the report 75% of the time. As we discussed in prior years, though, the report has often served as a plateau. Of the 28 times in the past 28 years that the S&P was at a 6-month high before the report, it showed flat to declining prices over the next 2 to 3 weeks 20 times. Options traders are really starting to perk up. The ISE exchange reported that equity option traders bought 200 call options for every 100 put options, the most extreme ratio since March. In the past year, ratios above 2 to 1 have mostly led to short-term price extremes. It can get more extreme, but it's a short-term warning. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:06 a.m. Mountain Time, and I'm recording this in preparation for the market day of June the 3rd, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And pretty much on scratch on all 4 of the U.S. broad market indices. 3 of the 4 just above scratch, 1 just below scratch, but none of them in a significant enough move to really draw any note. Crude oil is down just below scratch. Euro is down just below scratch. The bonds are up about 0.25%, and gold is up just above scratch. In overseas action, you have China up about 0.5%, Hong Kong up nearly 0.5%, Japan up nearly 0.5%, Germany up about 0.2%, and United Kingdom up about 1%. So pretty much what we expected in the U.S. markets coming into the monthly employment report, that we would have a market that would essentially go flat in anticipation of one of the most important reports on the month. In terms of U.S. macroeconomic reports of note for today, other than the related reports to the monthly employment reports, you do have trade balance report that will also be coming out. Though it comes out at the same time, and it will be totally covered up in the headlines, largely with discussion about the employment numbers. And let's see what else you might have here. ISM non-manufacturing PMI comes out after the market opens, so be aware of that. And then later in the trading session, you have FOMC member Brainard speaking. In terms of current volatility conditions, we have been decreasing on the 5-day versus 10-day. You also should note that the short-term VIX down to an 11 at this time. Skew somewhat elevated and coming into that 135 handle, at which point we start to really take notice. It becomes a caution once it goes over 125, and it is now approaching 135. IV percentiles, though, across all four of the markets are still very, very low. With two of them in single digits and the other two just barely above that. S&P is at a 10, the Russell at a 12, the Nasdaq at an 8, Dow at a 4. We did have one index, the Russell, turn in a standard deviation move yesterday. It was up by more than one standard deviation. The other indices less than one, and a close-to-close basis. Relatively, in the last 2 weeks, you've had fairly benign conditions with only two standard deviation type moves being put in on the S&P in the last 10 trading sessions. In terms of current charts, let's go ahead and go there. Our S&P futures, you look at this, we're kissing the bottom of that area of resistance. And I continue to stress each day that we're dealing with an area of resistance. And it's about 30 points, 35 points across, where you have these multiple touches right about where we are right now, about 2105 on S&P futures. We've had this serve as the resistance point and inflection point many, 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 many times. And remember, these are all daily candles. So this is like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. It's like 14 touches just since last July off of this particular area. But if you go back and look at the 2-year chart, you'll see that if you stretch back into May of 2015, we did probe several times up into this 2035 area. This shows the current 52-week high is 2126, but really it's just off the time frame of the chart here. And 2135 roughly is your all-time high. In fact, one of the morning author reading assignments was mentioning that. So you have this area of resistance that are just above us, and we are just right at the edge of that area. So it's going to be very, very interesting to see. And the monthly employment report is just the kind of impetus that can give you a surge of momentum and energy that could run up into that area of resistance. So this could be a very, very important trading morning. So we'll watch to see what that does. If we fail, then the leading theory at this point is that we will continue to play between this range of roughly some 100 points, this area of resistance on the top side, and this basic area, but essentially a double bottom area around the 2025 area as your bottom, and play within the cloud to up to this area. The third possibility, of course, is that that failed head and shoulders pattern that we had, that had the probe and then the bulls come rushing in to take us to where we are now, that could finally start to see a breakdown of that area. If we saw a breakdown, then we'd have several theories as to where that might go. But right now, we're looking for that energy to actually create the breakout. And we'll see if we get that energy today. In terms of the Dow, this has been running in a very close correlation with the S&P of late, with a little bit of relative weakness in the comparison, but the patterns have been essentially the same. You do see we have a lower high here compared to this swing high, whereas in the S&P, this is more closely associated with these former highs. So bottom line is that no new news to be gleaned as far as I'm concerned in looking at the Dow chart compared to the others. In terms of the Nasdaq, it's been playing somewhat catch up in terms of this prior swing high from April, and is up against this area. at the same time, you can see even back to the December highs, we're much higher than our current swing highs. So again, relatively weaker compared to the S&P. Normally, we don't look for the S&P to lead a strong bull market. A strong bull market's normally led by the Russell and the Nasdaq. Let's go ahead and take a look at the Russell market. And you see here, we have had a breakout over the most recent swing highs, and we're now coming, starting to really impress into these swing highs from last early December, though we're a long way away from the May highs and earlier from last year. So we've got probably over 100 points to go on the Russell before we get back to the same relative strength areas as those swing highs. So short term, Russell's been a bit stronger, but it's got more room to make up. In terms of the current bonds, let's see if bonds are giving us any insights. Bonds have been trying to break out. It's up into this diagonal area of resistance, and but not yet broke it out. It's on the edge of a cloud breakout. Certainly has more overhead resistance. Basically, we would call this, essentially a double top in the short term of this pattern here. Maybe something of a triangle forming with some, perhaps you could say this is slightly lower than this swing high, and then certainly this one's still in formation, and then you have a higher low with this swing pattern versus this, and then that was mostly off of a double bottom. We were looking at this as being more of an ascending triangle originally, but this may be starting to form into something that's more of a symmetrical triangle. Either way, the expectation is that this would break out to the bullish side because of the pattern that led into the secondary pattern. So we'll continue to watch how that develops. If that were to happen, and the reason this is so important is that if bonds break long, then we would expect that this, with the equity markets up against such a wall of resistance that have failed over and over again, that the equities would turn down. So that will be something to watch. In terms of volatility getting very, very low. And you see the VIX, basically on its floor. In fact, we're just kind of toying with this area. I've been wanting to put on some more volatility-based strategies, looking for an expansion in volatility, and I'd love to be able to get below a 13 to be able to put those on at some really optimal prices. And we've just kind of toyed with that level several times in recent weeks, and very quickly come back up off of it. So I've got some alerts set on, and we'll look to play that should we get below a 13 again. And then finally, let's take a look at gold. Gold has been just bedeviling chartists. A lot of people are suggesting that we're into an area of critical support, and that if the bulls are going to take this up for another leg, they basically need to do it now, and that this is, what some would suggest an entry point. Frankly, this is such a disappointing breakdown to me to come into this area and break through these former areas of support and patterns, breaking down through the cloud and so forth. I'm waiting to see what the resolution is to this pattern of the last few days and this coming into support, and to make some decisions about my own gold trade. It's got to kind of show itself here pretty soon, and certainly if it breaks down below this 12, we'll call it 1200 area, if it breaks down below that 1200 area, we're probably going back to the December lows. So very, very important inflection point on gold at this point. That's probably enough on the charts. Well, let's take a look at crude oil. Crude oil has been in a pretty tight correlation with the equities of late in terms of the ability to lead higher, And we've been watching, crude oil make a whole series of higher highs and higher lows. And of course, about a week ago, we had a higher high and basically been in something of a sideways consolidation pattern since then. It's hard to even call that a bull flag. It's so subtle in its pullback, but I suppose you could call it that still. Bottom line is that this isn't really showing anything in terms of breaking out to the long side quite yet. So we'll see if that or bonds in particular help to give us some indication as to where equities might go. And again, probably sideways going into this monthly employment report. This is probably being reflected in all these different reports. So, it's hard to make too much of the subtle tea leaf differences at this point until we get to that report and get the information that the market is looking for. In terms of the daily report, not a lot of changes from yesterday. We do have one change in our mechanical market timing signals. Let's go back to the top though. Market trend intermediate term phase opinion still at phase 2. Trend reversal. This is bullish. In terms of our 3 market timing signals, first one from IBD, confirmed uptrend, bullish. GMI index, a second signal, 6 out of 6, a buy signal, perfect, strong buy signal since 525. And then the third one, the stock charts decision point scoreboard. This one actually improved yesterday with a new buy signal on the short term in the Dow. So that gives us a universal bull set, complete set for the short term and the intermediate term across these 3 indices, and leaves us only with the mixed signals of the long term. And we've been talking about that this won't probably have any kind of resolution to give us the perfect stack until we break out of the all-time highs. So this is certainly when you put the consensus of these market timing signals together, and remember, these are 3 different signals, 3 totally different systems, and we look for consensus, and right now the consensus is clearly bullish, with a couple of these and most long-term signals still in some transition. So certainly short to intermediate term is a clear bull signal, but we have to be also aware, where are we on the chart, and we're smack up against significant resistance. In terms of position sizing opinions, as you would expect from the above signals, we're at 100% on both systems. In terms of the intermediate term market forecasts, we're a severely strong bull on the S&P, though yesterday was first day bearish on the Dow. So the first of 4 indices to break down and turn back to bearish. But the S&P, the Nasdaq, and the Russell all above 80 and very severely strong bull signals. Hedge warning status, currently level 1. We retain this somewhat elevated and first level of caution with our hedge warning status, in part because we're getting a number of signals that are related to warnings that are not normally present in a healthy bull market. And the second part of this is our position on the charts, that we're up against this wall of resistance that has been a failure point repeatedly in the last several weeks and months. So very, very hard to just be layering brand new positions on right and left in the face of such a failure point. In terms of strategy opinions, the VIX is inside the acceptable window to initiate new positions. Just be aware of where we are in the charts. Cover call strategies, I put one on yesterday, and certainly did use this 1-to-1 ratio of well, actually right at the money and then out of the money strikes. Also, this 1-to-1 ratio, low beta, high beta positions. If you look across my portfolio covered calls right now, you would see a spread of low beta and high beta positions. Also consider put selling with out of the money positions to be able to build your stock positions, or to just simply bring in premium. Consider the position size, though. Keep that in the scale you're willing to own. We're clearly not in a mode where it pays to be super aggressive. There's still too many warning signs. We're still up against that area of resistance. In terms of the specific warnings, that VIX futures daily squeeze is still present. We still have the distribution day count is somewhat high at a 6 for both the Nasdaq and the S&P, and the skew right on the verge of going over 135 is also a warning sign. We also, in the key intermarket risk aversion indicators, had our first rollover to risk off. And there's a couple others here that with any kind of weakness, even in one day, could go to risk off. So we're starting to see potentially the tide turn on this very, very sensitive indicator that often is the, one of our first tells that we're seeing a swing in the market from risk on to risk off. And so we'll continue to watch that. In terms of sentiment, short-term risk for stocks somewhat elevated at a 7 out of 10. Bonds also somewhat elevated. Semis are also from the ETF batch somewhat elevated. So watch for potential reversal patterns on those groups. From the CNN Money comes our Fear and Greed Index, and we are definitely in the upper quartile for an extreme greed and sentiment there. So again, watch for those reversal patterns. Sector specific, a sea of green now, and even retail, which has been playing catch up, now into the green with an up signal on both the short and intermediate. And retail has even in the long term gone to just barely into the neutral area. In terms of the percent change for yesterday, who are the leaders? Healthcare, telecom, and then followed by consumer discretionary and material. So primarily healthcare, much of this being led by biotech, but there's also some big traditional pharma. We've got a position in the trade room in J&J, and it did quite well yesterday. This is right now seemingly coming from a mix of the healthcare players. And indeed, from a consistency, you'd have to give healthcare, look at this, 1 day, 5 day, 1 month, 3 month, year to date, though barely positive on the year to date. At least it shows positive action across all those different time frames, and only consumer discretionary is able to make a similar case across all these various time frames. And I think that's probably enough for today. We've been a bit long of late. We've kind of playing a little bit of catch up on our analysis of the market, and a lot of important inflection points coming into play. But let's go ahead and go to our closing sequence. And of course, we must always do the disclaimers. So let me channel over to there. Hit the pause button if you see something you need more time on. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and then notice the full set of disclosures can be found at this hyperlink down here at the bottom. So in the meantime, we'll see you back here next week with the market preview for Monday being next on the calendar. And in the meantime, good trading, and keep it all in balance. Watch that risk management. That's what ultimately will control your profits.